The broader picture, though, is that, yeah, I still think we're in a economic backdrop that is unprecedented, unusual, from so many different circumstances, beginning in COVID, and that things remain bifurcated under the surface and challenging, but in the aggregate, from the high level, they remain okay.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest is best known for his HOPE framework, a highly effective way to measure the health of the economy and tell whether it's getting stronger or weaker. Well, as we enter the second half of 2025, where markets remain richly valued near all-time highs, what does this framework tell us 2025 has in store? To find out, we've got the good fortune to speak today with Michael Kantrowitz, Chief Investment Strategist and Managing Director at Piper Sandler. Michael, it's great to see you again. Thanks so much for joining us today.
Yeah, my pleasure, Adam. Always good to talk with you.
It's always good to talk with you, Michael. And I've had a number of people of late asking for your return. When it's been too long since you've been on this channel, folks start getting itchy. They very much value looking through your HOPE framework and a lot of questions about, well, okay, what is it telling us these days? So, the last time you were on this channel, Michael, in fact, the last couple of times, you talked a lot about the bifurcated economy that we have here. Some
Yeah.
parts of it doing well, some parts of it doing not so well, but kind of on average, good enough to kind of keep us out of recession, at least,
Yep.
looking through your HOPE indicators. Is that still the same, or are you seeing something different these days?
More of the same. In a way, there's been some now bifurcations within the bifurcations. So what I mean by, like, if you think about the economy, housing is very weak, and the AI story is still very strong. So that's at the macro level. Underneath that, if we just look at housing, you can say we now have a lot of bifurcation within housing. And you've seen, like, for example, some states are now seeing sharply rising inventory, sharply falling home prices. Yet in some states, you're not seeing that. You're still seeing very low inventory and very sticky home prices. So housing is getting more regional or even more bifurcated within itself. And the broader picture, though, is that, yeah, I still think we're in a economic backdrop that is unprecedented, unusual, from so many different circumstances, beginning in COVID, and that things remain bifurcated under the surface and challenging, but in the aggregate, from the high level, they remain okay.
All right, so I noticed that I referred to the HOPE framework a couple of times in this first minute or two here. For the very few people that may not have seen your previous appearances here, Michael, can you just give this 60-second dial through of what the HOPE framework is?
Sure. And I will, as I like to do, I like to show more than just, I don't want to be just a talking head. I want to be a talking head with images. So you could see my screen, right, Adam?
Yep, totally see it.
So I'll just zoom in. This is kind of the HOPE framework. It's a heat map. It's an illustration of how the economy and different indicators within the economy flow through in terms of a typical economic sequence. So you start off with housing, which tends to be thought of as an early cyclical indicator or early cycle indicator because it's very sensitive to changes in rates, which typically is followed by changes in orders or soft data like PMIs, which is followed by profits. And then lastly, all of that eventually flows downriver to companies' employment plans and whether they hire or are firing. So HOPE obviously stands for, well, that's what HOPE stands for. And yeah, we've been in a very unique environment here in terms of the debate around the economy landing, hard landing and soft landing, which that debate I would imagine still continues because there's been these ongoing recession fears. We always look for housing to firmly rebound because historically that's what ends an economic slowdown and gives you a broad-based recovery. And we've yet to see that. So we haven't landed yet, and we're still in this circling the runway, perhaps, and it could go on for a while longer.
So, it's interesting. So, talking to you, I mean, honestly, Michael, 2+ years ago, um, we had discussions about housing starting to look vulnerable because of rates, right? We saw things like transactions just totally dry up, right?
Mhm.
Um, what we hadn't really seen was lower prices, which we
Yeah.
are now seeing in a growing number of parts of the country, right? Um, but that's been a couple of years. So I'm just wondering, like, is this a progression that, once the H gets sick, does the contagion inevitably then pass to the O, to the P, and then to the E? Or do we sometimes go through parts of this cycle, but then they recover and we actually, experience a little bit of a hiccup, but we don't go into a recession and we get back to growth?
Yeah. Well, every cycle is, of course, a little bit different, and I think unfortunately, '07 is the last recession that we've really gone through, and it was a very bad one. And I think this backdrop has some similarities, but more differences. And so when I talk about the hope framework, it's not, each one of those segments can directly impact the other, but is not necessarily always certainly entirely the cause. So it's not that a weakness in housing makes manufacturing and services activity in and of itself weak. It's really that the conditions that have made for a weaker housing backdrop eventually flow and hit those other segments of the economy. So it's kind of the transmission mechanism. Beyond that, of course, there is a direct impact from housing to manufacturing. Think about cars, for example. When people buy homes, they usually buy cars, but
Mhm.
there's also many indirect ones. So it's not that necessarily the housing backdrop getting worse means that the rest of the economy will get worse. You could argue that this cycle's been so unique and that housing was really strong for a long period of time, and not that all that strength has spilled over to other parts of the economy necessarily, and now it's been weak for a while. So I think we have to kind of be careful about some of the linear conclusions we draw, because it's, macro's never linear for sure. And this cycle's got so many idiosyncrasies that we can kind of continue to discover. So yeah, you're right. And housing's has aged, I guess, as so have we. Housing has more gray hairs, perhaps, than it did 2 years ago. It's become more rate sensitive. I remember in 23 we were talking, and who would have thought that higher interest rates would have made home prices go up, which is ultimately what happened because of the unique backdrop with inventory or lack of. And now that's, it's aged, but it's slow. Question is, whether what we're seeing in housing today, rising inventory, falling home prices, will that accelerate a downturn in the economy? Will it propagate through the economy faster, perhaps? I'm not sure that it's a simple yes answer. I know you speak to many people who are very focused on housing, that are fantastic, but I think, in a sense, housing could be somewhat compartmentalized. And I think we just have to be careful of not drawing too many conclusions from certainly '07 and '08 in terms of how quickly housing blanketed the entire global economy, essentially. So I think the answer is somewhere in between.
Okay. I've got a question I'm dying to ask you here about housing, but real quick, maybe should we just dial through your key indicators to get a sense of,
Well,
of
yeah,
what
I
you
can show
see
you.
right now?
I can show you four charts that do a nice little summary of showing you where things are. And we
Okay.
look at a lot of different data sets for each segment of this framework. But if you look at like home sales right there, and just to start there, it's been sideways. We had this nosedive in 2022, and it seems we've hit this minimum level of activity because there's always going to be housing activity. There's always household formation, and then there's, of course, these, death, divorce, default, reasons, graduation that people move. And so there's still some level of activity. And obviously, there's a big difference between existing, which has been a lot weaker than new home sales. But so far, we've seen kind of this plateau. And I think you need I'm not so sure that necessarily housing on its own can make the rest of the economy really fall out of bed, or at least I think we still have got more cushion perhaps for that transmission to take place before we see it. Manufacturing, you'll notice all four of these charts look the same. They all took a nosedive in 22 and they're all going sideways. So you see the title there, from macro cycles to mini cycles, because
Hmm.
usually these, go on these 2 to 3 year cycles, and that's not what's happening. Everything's kind of stuck. And the PMI data, manufacturing has been really weak, as most know. But if you take an average of manufacturing and services to capture the whole economy, we have this unprecedented backdrop where you've been kind of hugging the 50 line for now 2.5 years. We've never seen that. It.
Right. And
So
sorry to interrupt, but the 50
no.
line is important just because it really represents the difference between expansion or contraction, correct?
Yes. Yeah. Above 50, things are improving. Below 50, things are deteriorating. And the more you're above or below 50, the faster that's happening.
Hmm.
So what that shows you is that nothing's really changed. And again, I mean that with a little bit of tongue in cheek, but nothing's really changed in the last couple of years. Again, I think things have aged. They've continued to evolve, but broadly speaking, of course, we have a new administration, and that's brought a bunch of new things about. But there hasn't been these radical shifts in the economy, besides AI to the positive side. And then what you're seeing in earnings revisions on the bottom left is again this backdrop where you've been largely stuck just below 50. About 45% of companies in a given month have seen a positive revision to their earnings. So if I showed you a longer term chart, and I can show you that later, you'll see that that's like that's a it's rare to stay there for this long. And right now we're at the high tide of the last couple of years. I think that's largely just normalizing the tariff collapse we saw in revisions in the month
Hmm.
of April. So remember, they're revisions. So if things overly revised to the downside and tariff levels then came down, then analysts have to raise their numbers a little bit. And then unemployment. And I remember talking to you last time, and I was more, I guess, constructive or not as negative on employment. I still kind of feel the same. That again, it's just this glacial softening of employment. I think the real risk here for markets is if we're going to have if are we going to get a shock where these things really accelerate? And right now, I don't really see that. Something, of
Okay.
course, could happen to change that, but
So let me ask you my question here then, because it may impact some of these things. So we've had student loans finally go back into repayment.
yep,
The new administration, says it's serious that these things need to be repaid. They're not going to be forgiven the way that a lot of folks were hoping over the past administration. And uh, it had been so long since these loans went back into repayment that people really kind of adjusted their spending. Sort of assuming that I'm probably never going to have to pay these things back. They're either going to get forgiven or, who knows when this is going to go back into repayment.
yep,
And now that they have to be repaid, this debt's special, right? It can't be dismissed in bankruptcy, and the government has the power to garnish your wages if you're not making your payments, right? So we're seeing delinquencies in student loans shoot the moon, right? And
yeah,
partially that's because they were at zero for the past several years.
yep.
Um, but I think we're seeing something like, 10 million borrowers already delinquent on their payments. And the question here is, does this have the potential to become like a debt contagion? Because we're also seeing delinquencies and other forms of consumer debt increase, and not quite as much as student loans, but you can understand the logic that like, well, if I've got this new debt I have to repay and I've got to repay this one, maybe I'm going to go light on my credit card repayments this month, or maybe I'm not going to pay my auto loan this month, or I'm not going to pay my rent or mortgage this month. Um, could this be somewhat of a new element here that starts to propagate across the consumer debt stack?
Yeah, and I think it's absolutely another negative that's stacking on top of already existing negatives. For housing, it's like home prices falling, which is a new part of the story that wasn't necessarily there a couple of years ago. The question the question that I think people have to think of is whether or not this issue or any issue, I mean, there's so many issues we could talk about or risks, whether they're going to be a contained industry specific or stock specific story, which I think these all are at a minimum, or they're going to become systemic and lead to some kind of shock. And how quickly will that happen? Because again, I think, literally any risk we can talk about today has to be idiosyncratic before it becomes systemic.
Hmm.
So you could talk about interest rates right now, the 10 years at 440 or so. Is that a systemic risk? Obviously it's not, because the market's, near all-time highs. Is it an idiosyncratic risk? Of course. There's plenty of stocks that have underperformed or gone down because rates are where they are. So I'm generally leaning still more that these risks are idiosyncratic. For it to become a issue for the market and the economy, I think first it has to come in the form of somewhat of a shock. And if it doesn't, it by definition would kind of play out over a longer period of time. And that's where there's more room for adjustment, or more room for just to lead to more bifurcation rather than an entire broad-based economic collapse.
Okay. And in bifurcation, so we've seen some parts of the economy do better than the others, and we've also seen, some percentage of households do better than others. Um, I have seen some data of late that suggests that the affluent consumer, who has really been keeping the averages propped up in terms of consumer spending, is starting to rein in their spending a little bit. Um, Meaning that maybe that bifurcation is maybe becoming a little bit less. But I don't follow this data nearly as closely as you do. Are you seeing something similar or not?
Well, it's hard to tell if how much of that was just kind of precautionary savings due to tariff uncertainty,
Hmm.
or other factors. Um, to me, my where the buck stops is in earnings more so than it is in the macro data. I mean, I use
Hmm.
macro data to try to infer where earnings are headed. And so we're still definitely seeing, to speak stock market, we're still seeing the mega cap earnings estimates and earnings continue to rise. And it's been the same story. It's the Mag 7, it's mega cap tech, it's comm services, some discretionary names. Um, so I don't see, we haven't seen that really change meaningfully. And I guess my basic view on the consumer is that, yeah, it's not hard to find really bearish consumer data right now. But again, the question is that representative of the aggregate? And the simple answer, people always talking about, or surprised, look, the consumer's been resilient. It's been resilient. Well, as long as as long as unemployment's not rising sharply, the consumer will be resilient, period.
Yep.
And so unemployment right now, if you look at the unemployment rate in the last year, it's gone sideways. It kind of looks like, it's not the bottom chart there is claims, but we're at 4.1 now, and we were as high as 4.3 and change. And there's of course all these nuances of what's been driving it, the numerator, denominator, but it really again hasn't changed meaningfully. Yeah, continuing claims have gone up. Initial claims have been up a little bit recently. But again, if the unemployment rate went up between now and year end, 0.2 or 0.1, I don't really, that's not that big of a deal. I think, it's just going to, it's just more softness perhaps, but it also then opens the door for the Fed to cut rates, which gets investors excited. So I just keep coming back to this backdrop that everything is moving at such a glacial pace. And part of it's because we have big deficits. Part of it's because 20% of personal income is derived from Social Security. Thus, 20% of the consumer spending is just basically people that are getting paid from the government to then therefore spend. So that's not gonna go away. They're not gonna lose that job. Let's hope so. So there's not a lot of negative macro impulses right now. And I hear you on the student loan repayments, and I think again that's an incremental negative, but I'm not so sure that that's going to by itself lead to a quick and broad-based deterioration with all of the other potential offsets we have going on in the economy right now. Oil prices are absurdly low right now. On a real basis, oil prices have to be at like multi-decade lows. And, everyone's watching gas prices go up 50, 40 cents here and there. But again, like I remember gas has been the same for the last 15, 20 years. So interest rates, yeah, they're elevated, but they've been at the same level for 2.5 years. And it's really rates of change that create these big cycles. And it's when rates go from really low to really, much higher, like we saw in 22, where you really get an economic hit, which we did see, but it wasn't big enough to cause a recession because obviously it happened during a time of great stimulus as well, from the fiscal side of things. So, um, sorry, long-winded answer, but I think there's a lot of things to worry about, but I think they're largely stock specific and maybe industry specific.
Okay. Well, we'll get to stocks in just a second here. Let me just ask these questions, and again, around the hope framework.
Yep.
Do you detect a bias in the framework right now? Meaning, it seems like everything's trending sideways for the painting with a very broad brush.
Mhm.
Um, on the margin, is there any sort of bias where you're like, yeah, it's kind of going sideways, but it's kind of trending downwards, or it's kind of trending upwards, or is it really it's just a sideways market right now, or sideways system
Yeah.
right now?
Yeah. Well, it's not a sideways market, that's for sure.
Yeah.
It, we can go. So housing is, agree, it's deteriorating in terms of lagging data. But the question is, will that lead to a deterioration leading data? So, we look at builder sentiment, that's fallen to 32 as the most recent reading. So that's on the weaker end of the range. You even look at total home sales, that's at the lower end of the range. So my view is that housing is going to keep getting worse. The question is whether it becomes kind of a negative shock and how quickly it gets worse. So on the profits and employment side, same thing. I would say it's going to continue softening. I certainly would not characterize this as any kind of a broad improvement or a positive tilt. If there is one, maybe it's to manufacturing. Parts of the tax package are going to allow for full expensing of investment. So
Yeah. We'll see new
perhaps,
factories get built and stuff. Yeah.
yeah. So that could help. So again, I would say it's mixed, but there's certain, I'd say housing and employment will continue to soften, but that doesn't get me quite bearish quite yet.
Okay. Yeah. It doesn't get you into recession warning territory. I totally get that.
Yep.
And on the employment side, the chart you had showed there was showing that I think it was initial claims kind of trending up. We know that continuing claims have been as well. Again, not at
Mhm.
any crazy pace yet. And in fact, the latest data we just got, had the unemployment rate go down to 4.1, which surprised people, right? But there's a lot of discussion about the actual unemployment rate in these claims, where uh, now that we sort of have this gig economy, there's a lot of states that haven't changed their unemployment benefits in a long time, like
Yeah.
decades. And so if you have the choice of like, well, I can take unemployment, or I can just slap an Uber sign on my car and drive some people around, I can actually do substantially better with the latter. And so the 4.1 unemployment rate might be a little bit of a false signal in terms of how well the American worker is doing, right? Because you have some people that are really struggling, but they are
Yeah.
getting out there and making something through this gig work versus just taking an unemployment check. But it doesn't mean that they're thriving. So I guess the question is
Yeah.
there a potential sense that unemployment, even though the headline stats look okay, might actually be a little bit worse than it is?
Um, I don't know. Be, well, but if you have the opportunity to receive income and there's jobs that allow for that, then why would that be a negative? I guess I would see that as more of a positive, maybe not fully employed, and there's underemployment data There's people that are falling out of the labor force potentially. I mean, there's been problems with with employment data at large for a long time. But again, that's why I go back to earnings data, which and revenue data, which kind of really where the buck stops.
The buck stops. I was sorry to interrupt you on this,
Yeah,
but you can expound, which is if it's concentrated, maybe some might say hyper concentrated into just a
yeah.
few industries or companies, is that really a sign of a healthy economy? If you have a few players who are doing great and pulling the average up, but you've got many players who are struggling?
Well, it it's a sign of. I mean, it's
It's a sign of
yeah.
your bifurcation. I totally
It's
get it.
yeah. I
Yeah.
mean, it's a bifurcated. I mean, it's just it's a reality of the conditions. We're obviously like that's a discussion on values and morals and political views, which we're not here to discuss that. We're here to discuss what those policies are creating, and again, I guess how to make money from that. So is it a healthy economy in the context of broadness and breadth? No. But again, that's exactly what we've been talking about for 3 years now, that things, there's strong winners and unfortunately losers. And one of the charts I can show you here. Okay, so this chart here is a chart on the top of what percentage of income comes from the government transfer payments. So Social Security is a biggest part of that. So when you think about income of consumers, it's compensation is the biggest, transfer payments probably the second largest, and then you have interest income and dividend income. Basically, that's all the money that consumers are getting from the government. I'm sorry, for income available to spend. So let's
Mhm.
just assume for simplicity that there's zero savings rate. So if 19% of personal income, or in this case now personal spending, is coming from the government, that all else equal, and again, not to debate if it's good or bad, just is a very stable source of spending. This has gone up over the years, largely due to demographics. The baby boomer population is quite large, and
So
we're
more
saving
people
Social
getting Social
Security.
Security. Yeah.
Yeah. And so just to make a comparison to 2007, for example, that number was about 14%. Another way to think about it is looking at the bottom part of that panel, which is how much of income or spending is derived from people working, employed, compensation. So again, in '07, that was about 66, 67%. So 2/3 of consumer spending was business cycle dependent on employment. Today, that's down to 60%. That's 6% decrease. That is huge.
Hmm.
So that's another, again, just a source of that's arguably making things more moderate from an income and spending perspective, maybe a little less cyclical than what certain conditions today would have created in the past. So that's another form of stabilization. And there's many others obviously we can talk about, but I think that's an important one. But yeah, there's a big gap between the winners and losers. A lot of that gap is explained by expense, margins for companies and disposable income for consumers. And a big part of what's keeping disposable income or margins weak is interest and high prices or high costs. And the irony here, unfortunate irony, at least in the near term, is well, we already have low oil prices, so I'm not sure how much lower those are going to go
Right.
without until people start thinking of the lack of investment, and we kind of put a floor in. You can get interest rates down, but it's going to be hard to get rates down meaningfully without higher unemployment. Well, as long as Powell's chairman of the Fed, so we'll see. That story could evolve.
Right. I mean, the breaking news on the day we're recording here is that apparently President Trump officially called for an investigation into Fed Chair Jerome Powell. So we'll see.
Yeah, yeah. Um, so yeah, we're plenty again, a lot of headlines, but we'll see. I think he's going to serve out his term, and the market will adapt.
Right.
So
He's got less than a year left. So
yeah, but you see the same thing in earnings, and in terms of bifurcation idea. Here's again a chart of ISM manufacturing and the percentage of positive earnings, and so we've been in this yellow band really since 2022. So we've how you get better market breadth. And people have continued to say, when is the market going to broaden out? Well, it's done so at times, not sustainably due to macro events where you get some relief from some macro issue. People think the Fed's going to cut. We get a good CPI report, but it doesn't sustain itself because there's not broad earnings to sustain that. You need to get earnings revisions up to 60, 70%, which is you typically see in, when the economy lands and recovers. So we're not there. And that's the reality of that. There's just not enough firms with positive earnings momentum to get that number up. But at the flip side, there's also not enough firms with negative earnings momentum to cause a big decline in the market from earnings or a big decline in the economy from employment.
So does this kind of go back to my question about the trajectory of this system? This is not a stock market, but in a stock market, you can have these periods of consolidation where the market can maybe get richly valued, but then if it trends sideways for long enough, it kind of works off the overvalued component and then is positioned for another rise ahead. Can you make an analog here, or like does going sideways tend to end up leading towards a reacceleration, or is there not a correlation like that?
Well, yeah, to kind of what you're speaking to, usually what you'll see, like in a recovery, the PE will go up a lot because the market moves ahead of the earnings being realized, and then the market will go up at a slower pace as the earnings growth.
As the earnings catch up, yeah.
Yep. Well, basically the market goes up less than earnings, so your PEs come down.
Yeah.
And I think that's kind of where, well, we're not in that kind of recovery, but certainly the market has recovered, not because the economy has recovered broadly coming out of a big slowdown, but more because the tariff levels have come down from April 2nd or from April 9th. So this is a chart of valuation, the PE of the S&P 500 with credit spreads on the other axis inverted, just to highlight the point that PEs move with credit spreads as kind of a mirror image. They're both measures of risk premia. And we've pretty much priced out most macro risk in the last 3 months.
Meaning market's not very worried about much.
People are worried about plenty of stuff. And again, that's where my point about that's more idiosyncratic. Like you're still seeing the effect of, certain names are underperforming or outperforming because they have more or less exposure to tariffs, let's say. Same thing you could say about interest rates. But is the market, both the credit markets and the stock markets, small caps included, worried about much right now? No. Is that a bearish thing? Not necessarily, but does it portend lower returns going forward? I think so.
Yeah.
Not negative necessarily. That'll be a question of something, whether a risk pops up that the market reacts to.
Yeah. And to your graduated indicators on this chart, right? Goldilocks is an extreme, just as doom and gloom is an extreme on the other end, right? So historically, we only have a couple of years on this chart, but historically, how long is the market able to persist at an extreme?
Well, you can't really create those bands across long periods of time because I guess there's two things that determine the level of the PE. One is generally the fundamentals of the index. So we happen to have a S&P 500 today that has got much better fundamentals than any time in the past. That's a fact. And index concentration that's less cyclical in terms of its sector representation. So it does warrant a higher PE. Short term, think of 2025, the PE is higher today because, well, we just had the big tariff scare and, Trump backed off and, we're maybe closer to rate cuts. Maybe inflation's not going to be as horrible as people thought 3 months ago. Maybe the economy's not going to go into recession immediately like people thought 3 months ago. So all that macro risk has been priced out. So we're kind of back to where we were. And there's certainly today a lot more optimism than where things were 3 months ago. And I would even say 3 months ago, things were at an extreme, even though they weren't, at doom and gloom. So, again, those are kind of, I guess, a little bit subjective bands, but you could stay. I mean, we were there in 2021. You could see that there. But I think there's an important point I want to make about valuations is valuations go down because a macro risk pops up.
Mm-hmm.
So in 2021, people, could say, well, the stock market fell, 30% because the PE was high. Maybe, I don't, can't disprove that necessarily, but the stock market fell because inflation, had the first, we had the first inflation shock in 40 years. It wasn't because the market was high. And in fact, actually, a lot of the cheaper stocks went down more than the more expensive stocks. Not that's not totally the case, but I'm just saying, like, small caps went down a heck of a lot more in parts of that, like the Russell. A lot of growth stocks got hit that, were trading at ridiculous valuations during COVID. So that took, the NASDAQ down a lot. But point is that valuation is not always a great determinant of future returns, even in a down market. And where we are today is a reflection of, again, the fundamentals of the index and the current perception of macro risk, which is very low right now. And the question, again, is, well, why do PEs go down? It's really three different buckets: interest rates and inflation spike. That's bucket number one. That was 2022. Unemployment spikes. That's a recession typically.
Mm-hmm.
And the third one is kind of a kitchen sink of anything from tariffs to long-term capital management to, whatever else is not one of those
So
first two.
your black swan bucket. It's just
Yeah, well, exogenous shocks.
Yeah.
I don't think we're going to see a spike in interest rates or inflation that's going to take down the market in a meaningful way. I don't think in the near term, I don't think this year we're going to see a spike in unemployment. And not to say that it may not go up or could go up, but I just don't think it's going to go up fast enough, sharp enough to cause a big downturn in markets.
Mm-hmm.
The third bucket, geez, who knows? we got a lot of tariff headlines these days. So, but no, I don't think we're going back to April 2nd levels or. So my base case here is that multiples more or less stay at these levels.
Okay, for some prolonged period
Until one of those three things happens.
until one of those things happen. Okay,
But my point is to fight the market because multiples are high. Again, markets don't go down because, in my opinion, and everyone can have their own views, they don't go down because they're expensive. They go down because something bad happens. And you can go back and throughout every major peak downturn in the market, which is all the corrections and bear markets, something bad happens. In the absence of one of those three things happening, the markets will grind higher because earnings will continue to grind higher. And that's the other component of the story. So I'm not delusional. I'm not saying the market's going to go up another 20% from here. And I do believe there's not a lot of risk priced in. And if something pops up, the market, maybe goes nowhere or pulls back a little bit. But in the absence of a rate shock, employment shock, and some kind of exogenous shock, what you're going to see in markets going forward is they're going to trend with earnings, which move a lot slower. And so if we look at, just ignore the title there for a second. This is just the S&P 100, 500, 400, and 600. So mega caps down to small caps.
Mm-hmm.
These are indexed from the beginning of 2022. And that's what we're looking at. So this is the poster child of bifurcation. So if you think of small caps, well, they've gone up a lot in the last 3 months. Why did they go up? It wasn't because of earnings. It was because the same reason large caps went up. It was because we have less risk around tariffs, inflation, and recession. Now, from here, for that to continue, unless you're going to get mass exuberance, more risk appetite in investors, and the PE is going to go up even more, then it becomes a function of earnings, kind of, which is what you were talking about earlier. And small cap earnings as an index are not going up. So that's definitely an area you want to be a stock picker, not owning the aggregate.
Got it. Can I say a really minutia question here? So you got the S&P 100 and the S&P 400. Presumably the S&P 500 is those two put together?
Mm-mm. The 100 is the largest 100 stocks. The 500 is inclusive, or the 100's in the 500. The 400's the next 400 mid-cap stocks after the 500.
Okay, that's kind of what I was asking, which is the 500 is the 100 plus the 400, right? The S&P 500 includes those 400 plus the 100.
So put aside the 100 for a second. You have the S&P 500.
Yep.
So the 100 is in is the top 100 of the S&P 500.
Yep.
Okay, so then the S&P 400 is
The bottom 400. Yep.
it's not. It's not the bottom. It's the next after 500 stocks. It's the next 400. So the 500
Oh,
to the 400 basically give you 900 stocks.
so it's stock 501 through 900.
Correct. And then you got the 600 below the 400. Collectively, those three indices, 5, 4, 6, give you the S&P 1500.
Okay, got it. All right, that makes a lot more sense then as to the performance of these indices. So, okay, thanks.
Yep. And S&P 500 equal weighted earnings estimates are also, they're not on this chart, but those are also at new all-time highs.
Yep. Okay, got it. Do me a favor, can you go back to that chart you were at for just a second here?
Yeah, which one was it again?
The one that had the gradations, yeah. And if you
Oh,
can't find it
the
easily, don't worry
valuation.
about
Yeah,
it.
yeah, it's up here in the beginning.
Looking at this just sort of with a high level eye, it's at least in this data set, stocks don't stay in this Goldilocks elevation for too long.
Yep.
When they were before in 2021, we had 2022, obviously, and then when they were here coming into 2025, we then had March and April, which is what, a 20% correction. So to your point, I totally agree, and a lot of the experts on this channel echo the same sentiment, which is that, look, valuations are a terrible timing mechanism. Don't use them to time the markets. Just use them as sort of an indicator of future returns, like over the next 10 years. And you're kind of like, maybe, but
I mean, no one's going to remember this conversation in 10 years.
Yeah, but better indicator of that than like what's going to happen in the next quarter, right, with stocks.
Yeah. And although I would argue just why not? Business cycles tend to be 10 years. So I think that's part of why that relationship exists,
Okay,
but
fair.
maybe.
Yeah.
But yeah, I agree with that.
But I think, sort of like, hey, the further stretch PEs get, you're stealing value from the future, and therefore future returns should be lower when you get to extremes, right? And the general logic, yeah.
Absolutely.
So the thing that's going to, but the thing that causes the change, as you were sort of saying, is things that impact earnings, right? Things that are going to impact earnings, right? Or at least earnings expectations, right?
Yeah, I mean, ultimately, you could argue like, well, every downturn, there was always some fear of the economy, going into recession. But yeah, it's things that impact earnings, though you don't always see earnings estimates change when the markets go down, depending on how long the markets are down for. But yeah, I guess you could think of it like that. I mean, in 2022, like it impacted earnings, of course.
Right. And earlier this year, the freak out about the tariffs, it didn't impact earnings directly, but everybody was freaked out about future earnings because they thought,
well,
hey,
that's
if tariffs get slapped on, it's going to really impact earnings, right?
Yeah. Well, I think that's important. I mean, that's when I talk about earnings, it is future earnings, which I would say that's what the market certainly most correlates with. So yeah, it's always I often argue the market's not very forward looking, but then at the same time I'll say, well, look, markets are always kind of reflecting future earnings. So I put my foot in my mouth a little bit, but again, the view on future earnings I think tends to be a projection or extrapolation of what people think today. And as we get new information, like we saw with tariffs, those estimates will change. So kind of really making it reactive rather than just extrapolating a line going up over time. So, but we're at levels where, actually, Adam, I have charts that could answer the question you asked me earlier of how long do we stay here? Because, at the beginning of the year, this is one of the charts we highlighted that, look, basically, the beginning of the year, our message was that market returns aren't going to be great in 2025 because of everything we just talked about. And again, the way I expressed it is that how much macro risk, how much are people worried about stuff? Because when you worry about something and it's priced into the market through wide spreads and lower declines in multiples, you could price it out of the market And that's, I mean, literally why we get markets that go down and then rebound. I mean, think, CPI went down, went up, and then it came down. Markets went down, then they went up. Same thing with tariffs. So when we look at the past decade, yeah, we've been here. We were arguably here at the end of 2014, 17, 21, and at the end of last year. And the point is not a certain level on the PE, because you can't do that across time because the index changes, but more so you can do it with credit spreads more consistently. So that bottom right chart, that's a way you could argue is a little more normalized than PE levels. And so I've circled those 4 periods where we were more or less at low levels of macro risk. And that's where if something really bad happened or something bad happens, the markets will react more quickly, perhaps. But the point is, again, in 2018, we had, the market worried about rising rates. 2022, of course, we had inflation. 2015, we had oil prices collapse and, China devaluing. And then in 2025, obviously, we've had tariffs.
Yeah, so I'm curious, when we're in one of those golden square extremes, does the phrase, and I'm not trying to be overly leading here, but I'm just trying to think about this. Does the phrase sort of
price for
bubble
perfection?
well,
Sorry.
that or bubble in search of a pin, meaning it's at this extreme, but it is much more likely to be reactive to a negative surprise, right? So it's floating up there in the ether.
Yeah.
But if there's a development that catches the market by surprise, it's much more likely to react more violently.
Yeah, and I think it's not only because, well, I think it results in positioning being very one-sided and thinking being one-sided. So yeah, anytime the market's surprised to the upside or the downside, you get bigger moves. So bigger moves plus, everyone basically on the same page for, 12 months or 3 months can create, it can exacerbate that. So yeah, it does. And though the question is, though, do you want to be bearish or shorting stocks because that might, something bad might happen? Or do you want to position a portfolio and buy stocks and allocate your exposures to risk assets in a way that makes more sense for that environment? And I think that's a really important difference because, I've tweeted with a lot of people on Twitter this year that, especially in the last couple of months, while valuations have gone up. And I think there's a difference between being bearish and positioning for a backdrop where valuations are rich and there's more optimism already embedded in the market, and perhaps you see lower forward returns. So I think given that markets generally go up and earnings generally go up, you're better off most times positioning in a more cautious way or acknowledging that risk to the downside than just try to short stocks and go against, the tape.
Yeah, and so I want to hear you answer that question if you don't mind, because what I'm taking from all of this, Michael, and again, you've done exactly what I was hoping you would do here, is kind of lay out all the data for us about how you see the world right now, which, as I take it, is, hey, systemically, I'm not seeing anything that dire, right?
Yep.
So, but what I am seeing is that the market is very confident right now, and perhaps a little bit too confident, right? But that being said, we have to trade the markets we have, not the markets that we think we should have, right? So take another analogy, the music's still playing. You don't see reason to leave the dance floor and go home yet. But some people say, but maybe you might want to be dancing a little bit closer to the door, just in case something surprises the market and whatnot, because multiples are so elevated and the market could react more violently to surprise news. So the question is okay, so in that type of market environment, where you don't see a danger of us going into recession anytime soon, but you think things are richly priced and the market could be more reactive than normal, what is a prudent way to position your capital?
Well, the irony, I think, is that, we've been relative bears on small caps since the end of 2021. And again, they haven't really, they're kind of where they were for the last 3 years. They haven't really gone up. But there's been this ongoing hope that they start to outperform sustainably and recover. And I do too, because that's a much better economic backdrop for, I think, all. But we're not seeing those earnings improve, we don't have those conditions to support that backdrop. So you've seen small caps have had a huge rebound in the last 3 months. And the irony here is that if you're worried about valuation in the S&P 500, unless you get a downturn that is very contained to the Mag 7, which almost seems like a oxymoron,
Mm-hmm.
the irony is that small caps are actually the ones you should worry about if you're worried about equities being too richly valued. From the lows in the market, multiples for small caps and large caps are up pretty much the same percentage amount. Small caps actually may be up even more because they've earnings estimates haven't gone up. So if you're worried about earnings being too high, the estimates for the street, well, look at the small cap universe in terms of earnings expectations over the next 12 months. They are much higher than large cap earnings estimates. And if earnings estimates are going to broadly fall for large caps, because either we get some tariff rate inflation crisis scare or unemployment goes up, again, I don't think the names with the highest expectations in small caps are where you want to be. So I think, again, it's a tough index to own, but it's a great place to pick stocks because you get a lot of differentiation in that space. So positioning for this backdrop, which is, okay, everyone's priced out all the bad news. Credit spreads have come down. High yield spreads are back to, where we were at the beginning of the year. And that's more important to me actually than where the multiple is. Because again, the multiple can go down if any risk shows up from any level. So I think you want to be, if I had to pick an index, I'd again want to move into larger companies because I think they have more of a macro moat to withstand tariff, inflation, interest rate risks.
Mm-hmm. So S&P 500 because of the bigger companies, S&P 100 or Mag 7? Like where are you dividing your line on big companies?
Yeah, I would say more the 500
Okay.
than the Mag 7, but there's some Mag 7 stocks that do rank well in our models. There's some that do not. But it's companies, I could speak more broadly. It's companies that, again, that are doing well fundamentally in this backdrop. Because again, like Adam, the backdrop hasn't, you just said it, it's gotten worse. Housing's gotten worse, and we've got tariffs, and rates are where they've been for the last 2 years. So that's a worse backdrop. So if a company has not been operating well in the last year or two, how's it going to operate better in this backdrop? And in the aggregates, that's exactly what you're seeing at the sector level, at the market level, in the consumer level. So you'd want to be in companies that, particularly after the last 2 months, and I can connect the longer term story to the short term.
Mm-hmm.
Don't extrapolate the last 2 months, 3 months. What outperforms in a market rebound after a 20% correction, unless it's the beginning of a big, broad economic recovery after recession, is very unlikely to sustain itself. And we've had this, the number one factor in Q2 was beta. It's because the second quarter basically started near the low of the market, and the market was up a ton. I wouldn't be owning or overweighting higher beta stocks today or lower quality stocks, even though, look, they probably went up a lot in the last 3 months. But why did they go up so much? If all of these stocks, if so many stocks went up so much, it's got nothing to do with their company's fundamentals or their management or anything. It's all macro. And if that macro story is fading, or if it gets worse and goes the other way, the names that are just rising with that tide are the ones that are going to go out with the tide as well. So it's about stronger fundamentals, good free cash flow. Valuations, a great add-on to that. I think it's okay to pay up for good fundamentals. It's not good to pay up for just hope in a speculative sense.
Okay, but and I'm not saying you're recommending these names, but it's the ones that have done well in the relatively recent past, meaning past year or two in this current environment, not just the recovery since April. So the
Yeah.
NVIDIAs, the Microsofts, the Palantirs, the ones that have just kind of been crushing it in this current environment.
Companies with strong earnings revisions, high profitability, a lot of free cash flow, and those are all many of those companies you just mentioned are
Tick
in
those
our
boxes.
long
Yeah.
models. I think there's small cap companies again too. Again, the last couple of years, yeah, the index has not done well, but many small cap stocks have done much better than the Mag 7. And either those stocks are just extremely speculative or they've got really good fundamentals. And there's plenty of them with really good fundamentals. So I think for stock pickers, there's taking those same attributes and finding those within the smaller cap space that's less covered by Wall Street, perhaps, could be a good place to look for mispriced goods.
Okay. So one of the things I hear you saying here, and correct me if I'm mishearing you, but is that this was a good market for active management because alpha is probably going to become more important than beta. Beta just had its brief moment in the sun with this recovery.
Yep.
But also because we have some of these risks, right? In the hope, each of these hope areas, if they were to start building to the downside, you're not saying they are, but if they were, presumably the better companies are going to withstand that storm better than just the general indices, right?
Yes. Yeah. And I think that's an important takeaway is that, if you're worried about things again, you can position two ways. And I think, I've certainly learned my lesson in 2023. And that was a year where I was bearish for too long. But, ironically, we got our positioning calls very right because, we make a market call and we make a positioning call.
Mhm.
And so, yeah, and that's where I think it makes the most sense. Yeah. Better quality companies, larger companies, economies of scale, pricing power,
Right. But the point there
labor.
is you got to do your homework, right? You got to go find those companies and you got to build a
Yeah.
portfolio about them. You can't just blindly buy the index ETF or whatnot that people have become so accustomed to doing over the past 15 years. I mean, you can do it. You're just saying
Yeah.
you're probably likely to underperform versus a successful active portfolio.
Well, I think particularly from where we are right now as we speak today, compared to 3 months ago or 2 months ago, where you could have thrown a dart and the stock would have gone up.
Right. But that's because everything had washed out. Yeah.
Everything went up, more or less.
Yeah. Yeah. All right. Well,
So
look, one of the things I really appreciate about talking with you, Michael, is not just all the data that you bring, but also your transparency in terms of where you see the market going and how you think the best way to play that is. So I
yeah,
appreciate you doing all that. Same again here. For folks that have enjoyed this discussion and would like to follow you and your work in between now and the next time you come on this channel, where should they go?
sure. I am on X. My handle's Michael Kantrowitz. We've also recently partnered at Piper Sandler with Simplify Asset Management. We've launched a small cap active ETF. So again, I think it's a tough time for the index, but as an active manager, it's a great time to be an active stock picker in the small cap space because there's so much differentiation there. The ticker of that is Little, LITL. It's the simplified Piper Sandler Small Cap Plus Income Fund is the full mouthful name of it. And then, I'm on the popular financial media every so often. So
Great. So
find me
folks
there.
can Google your name and find your interviews beyond just through ones on this channel.
Yep.
So I just got to ask because I just released an interview with Mike Green from Simplify the other
Oh
day.
yeah.
Dear path and his cross, and is it just horrible having to work with him, or
Ah,
you guys get along?
no. You just got to have your expectations aligned. No, Mike's great.
Mike is great.
He's super passionate about what he does, and I think sometimes people confuse passion for aggression.
No, look, I'm a huge fan of Mike, and I
Which
said
with
that
me
only to
too.
just kind of get a dig on him. Now, and Mike is one of those guys too. He's just a hyper intellectual. He's always a super interesting guy to talk to. I
Yeah,
always
no,
learn
he's a
something.
great. He's a great follow, and he was just posting something that I was like, hey, how'd you put that together? And yeah, so we have a great relationship. And he's you got to have smart people around you. That's something certainly is a great asset.
Well, that's very true. And look, I've been doing this long enough that I interview a lot of people in this space, your peer set and whatnot, Michael, and I really like it when I see smart people of, good character coming together. It's almost sort of like, the Marvel movie mashups where you get, these great superheroes coming together to do great things together. So I'm glad to see you guys at Piper and the Simplified team doing that.
Yeah, yeah, it's super exciting, and hopefully there'll be more.
All right. Well, look, as we wrap up here, Mike, is there anything else that's burning brightly on your radar here that I didn't ask you about that's worth sharing with this audience?
Uh, Hopefully it's a quiet summer and everyone can enjoy it. But yeah, we'll see. We got inflation coming up. Again, there's some warning signs there. Given where the market is, maybe in the short term that could lead to a little bit of hiccup. But anything else that you haven't mentioned?
Well,
I
I'm
mean,
concerned just because you mentioned inflation. Not concerned, but I'm curious. In the past less than 24 hours, we had the president send a bunch of letters to a bunch of countries, basically saying, hey, look, we haven't negotiated a deal yet. So since we haven't, we're putting a tariff of X on you. I think the average is something like 30 plus percent. Um, these to go into effect, I think, in the beginning of August, unless a better deal is negotiated in between now and then. Is there any heightened concern on your end that these deals don't get done and these higher tariffs get placed, and then there actually is some sort of price shock from that in the future?
so
Or is
there's
this
a
just the game that's been being
yeah,
played? And hey,
you
we're not
know,
going to worry until we see
I was told 3 years ago that people had macro fatigue. I don't know what you call it now. So
macro
I,
exhaustion.
Uh, yeah, macro delirium or whatever.
Delirium. Yeah.
Um, I don't, again, we've already been shocked by that. We're not going to get shocked, in my opinion, the same way we did in March and April.
Mhm.
And I think the way I'm thinking about it a little bit is similar to inflation. So yes, we have higher tariffs. No, they're not systemic at the current levels when you look at in aggregate. Think about inflation and CPI. 2022, we were shocked by CPI. Price levels are even higher today than where they were in 2022.
Mhm.
And again, it's an idiosyncratic problem. It's something that separates the stronger from the weaker companies and consumers, but it's not systemic. So that's kind of how I'm seeing tariffs going forward, is that, we have to recognize that there's going to be a negative impact to that. And I am again, decide whether or not it's going to be a company or industry specific issue versus something systemic. And I think CPI is a good analog. Again, prices are not down from where they were in 2022, but it was the shock that really hits us hard. So um, I think markets will, yeah, there's macro exhaustion and policy exhaustion, I think. And I think at the end of the day, I'm hearing this more and more for clients. They just want to figure out, what their company's earnings are going to be. And as long as we don't get a shock, try to avoid a lot of this noise.
Okay. And as a capital manager, is that almost liberating? Does it just give you a chance to just kind of look at what earnings are? And until something shocks the market, you literally just trade what the tape is telling you?
Yeah, I think in some way you have to, the macro noise, and I don't mean it in noise and meaningless way, but just the macro volume has been turned up so high in the last several years. And increasingly, it just seems like it keeps going higher because all these things are compounding on each other. You just mentioned the student loans, like we were talking about that a couple of years, you and I, but people were talking about that years ago, and now
Mhm.
it's compounding on these other things we're compounding: tariffs and inflation and high price levels and high interest rates. So, um, yeah, there's just so much myopia right now, and you're seeing it in the market's narrative volatility.
Yeah. Well, the market seems to essentially have just said, I'm not even going to listen to it anymore, right?
Yeah, so I mean, what I'm constantly thinking is what hasn't happened yet that's going to maybe happen. I
Right.
mean,
Which is hard, right? Because sort of definition of a market surprise or a black
yeah,
swan or whatever you want to call it is something
exactly.
the market hasn't thought of, right?
Exactly. Exactly. It's like we've hit, everything from oil shocks to inflation shocks to rate cycles to we've had plenty of periods of recession fear, political, geopolitical. So hopefully it's a good thing.
All right. Well, anyways, whatever happens from here, Michael, love to have you back on in a quarter to kind of, give us the audible update on what your framework is telling us. Folks, if you've enjoyed having Michael on here, please let him know by hitting the like button and then clicking on that subscribe button below. If you've taken some inspiration here from Michael's presentation here, and either are interested in looking for alpha in some of those types of companies that he described to us, or just looking for protection against a market that is clearly not worried about macro risks right now. Highly recommend you get that guidance from a good professional financial advisor, but importantly, one that takes into account the macro issues that Michael has mentioned here. If you've got a good one who's doing that for you and then executing on that for you as well, great, you should stick with them. But if you don't, or if you'd like a second opinion from one who does meet that criteria, then I highly recommend that you consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations, as a reminder, are totally free. There's no commitment to work with these firms. It's just a free service they offer to be as helpful as possible. Michael, can't thank you enough. Really appreciate you coming on. Like I said, I'd love to have you back on again in the not too distant future.
All right. Happy to join you anytime, Adam. Love your
Thank you, buddy.
show and your content. Thanks.
Thank you. All right. And everybody else, thanks so much for watching.